Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Friday. If this is your first time seeing one of my videos, welcome to my channel where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So I didn't do a video last week. I was in Massachusetts, but not a whole lot happened the Thanksgiving week, which was good because there wasn't a lot of news and rates stayed very flat, which is an indicator that things are moving to a more, at least neutral place where no news leads to no change in rates, whereas we had been in a place where no news tend to worsen rates. This week very much continued that trend. Rates have gotten better over the week, and there wasn't a whole lot of real economic data that explains why that happened. The biggest reason that seemed to be the cause was one of the Fed chairmen, Waller, said that he could see the Fed cutting rates in 3, 4, 5 months if inflation continues to come down. So I think the market took that as a indicator that even if we're not at 2% inflation, the Fed may consider cutting rates. We'll see. Today, Jerome Powell, the head of the Fed, was much less willing to say that. They're about to start cutting rates. And we had some inflation news on Thursday. The Personal Consumption Expenditures Report, or PCE, which is the Fed's preferred method of inflation, that came in as expected overall, but the shelter component came in a little bit higher than I would like. It was 6.92% after year over year, after being at 7.15% year over year. So only a 2.3% decline. What does that mean? Well, it's another data point in the overall picture of shelter, showing that it might not be declining quite as quickly as I would hope, and that we may not be getting to 2% overall inflation as soon as I would hope. However, it's important to note that if unemployment, the Fed has two primary focuses: keeping inflation low and making sure the economy doesn't crash, making sure we avoid recession at all costs. So this is a dual mandate, and sometimes these conflict. Inflation has been getting better, even though it's not down to 2%. It has been getting better, while unemployment is slowly going up. It's, in general, still historically very low at 3.9%. However, it's worth noting that historically, once inflation has started to creep up a little bit, it tends to compound and start going up a lot. And that will cause a recession. So this next week, on Friday, we'll have November unemployment. And if that number comes in a good bit higher, I would expect if we're still in a good spot, it should come in 3.9%, 4% flat, something like that. I would say would be just continuing as is with a still strong economy. However, if we're looking at more like 4.2% or higher, that would really be an indicator that the Fed is going to probably start cutting rates a lot sooner than they would ideally like. If inflation is declining at the rate that I'm expecting it to decline now, which is between PCE and CPI, it's been about 0.3%. It's probably going to take a good year or so before overall inflation is down to 2%, maybe even a little longer. Now, that could always change. We'll see what inflation looks like next month, but this is just based on the last 3 months or so, which seem to be a little steeper than the previous period. But if unemployment starts to go up, I think it's not going to matter, and the Fed will cut rates, which will be great for mortgage rates. So as always, if you have any questions or comments, shoot them below, or you can always call or text me on my cell phone. But thanks for tuning in to this one, and I will see you next week.